Hello again, everybody. Dr. Richard Smith here with Trading Market Cycles on Cycles TV. So good to be back with you again after another very interesting week of action in the markets. And the question that I'm posing today is Powell pivot? I'm not so sure. So we're going to dig into it. It's going to be a little nerdy today, let's say. We're going to get into the weeds a bit on what happened on Friday with the Jackson Hole speech and what our ongoing macro thesis is rooted in our cycles analysis, our longer term cycles analysis. See if it has any implications for our portfolio. Explore some of your comments, which I've really been appreciating, and keep sorting this out together. So thank you, everybody who's joining and who contributed last week, and especially in the weeks before. I really like how our conversation is evolving, how we're putting our heads together on this, how more people are contributing. I love human intelligence. I think it's the most valuable thing on the face of the earth, and far superior than what Sam Altman is telling us we should be doing. So thank you, and we will continue to dig into it today and see where we think things are going and make sure we're responding to current events as much as possible. So thanks again for joining, and without further ado, let's start to get in the weeds a bit here. So let me make some adjustments on my screen here, and gonna start out now with the playbook that I've been developing here using ChatGPT, because ChatGPT is, and these other LLM tools are incredible tools for organizing your own thoughts, not for doing your thinking for you. Just doesn't work. Has to be a human in the loop, and we got to be the best possible humans we can be, so we can be the best human in the loop. But with these tools to help organize our thoughts, our insights, what we're learning from each other, they're incredible tools. And I continue to use this to keep my best thoughts in front of me. And I've started out by putting at the top of this little canvas, it's called in ChatGPT, a quote from Eisenhower: "Plans are worthless, but planning is everything." And boy, did that sure ring true on Friday when Powell came out and said unemployment may justify some easing, right? A policy adjustment. And boy, that was all the markets needed to hear: policy adjustment. 2 words that sent everything soaring in the opposite direction of my theses about what should happen in the markets over the next 3 to 6 months, right? So plans are worthless, but planning is everything. So yes, we have to plan. Sometimes, you know, as Mike Tyson said, everybody's got a plan until they get punched in the nose. And Friday, I got punched in the nose. Was it a game changer? Was it a turning point? Was it just a big running of the stops before the moves that I've been planning for start to unfold more convincingly? Don't know yet. We're going to continue to explore that question today. Look at what we learned, look at what happened, and continue to plan, do our planning, and then be able to be in a better position to respond to events instead of react to them. Okay? I am the doctor of uncertainty, after all. I understand that uncertainty is inescapable in markets, and there is no sure thing. There are only probabilities. And if, you know, that's the part of one of the challenges of cycles, is sometimes they look so compelling and so seductive, and we're just looking for somebody to give us the answer. But there's only planning and then you have to respond in the moment to what is presented. So keeping that reminder up front. Current cycles outlook, equities and crypto at risk of topping within the next 6 months. And just quickly on that point, here's two charts. We've seen them before, but here's the daily data on the E-mini S&P 500. We got a couple of, pretty clear cycles here at 129 and 200. We've talked about this declining momentum divergence, even with these new highs. Look at this declining momentum divergence, right? So, I mean, that move, not quite the new highs, right? Here's the move on Friday, right up into here. Didn't make new highs, barely even turned up the momentum. So, it was a painful one day if you were short the S&P 500, which, I'm not short in size yet. I'm just looking for an opportunity to be short in size. So I am not convinced that what we saw was something enduring in equities. And this is, what we've been seeing on the S&P 500 for a while now. And similarly in Ethereum, another one here, right? We got a couple of strong cycles, 59 and 169, can even add in the 139. We don't have negative momentum divergence, maybe from way back here, but Ethereum's been on a tear. It's overbought. Cycles are extended, looking for a downturn. But meanwhile, that's not what we got on Friday. Okay, we got a rip-roaring rally. In fact, let's look over here for just a minute. Ethereum on Friday from the low to the high was up 16%. And its typical move in a day is about 3.22%. So it was up 5 times its already large standard deviation. So, 60% of the time, 65% of the time, Ethereum moves about 3% a day. It moved 16% on Friday from low to high. Meanwhile, it's given back some of those gains. Bitcoin moved up 5%. That was 3.5 times its standard deviation. So these were huge moves on Friday. This is the Friday moves after the Powell speech. Okay. What was the change from high to low, and what's the normal move prior to Friday? And then how big was that move versus its normal move? So Ethereum was way out on a limb, silver was way out on a limb, etc., etc. All right, so let me get back here now. Treasuries. So this came up last week and somebody raised it in the comments, which I appreciate it. Our analysis of treasuries last week did sort of favor the idea of a bull steepening instead of a bear steepening. So I've made that correction in that adjustment in my roadmap, that right now yields falling more in the 2 to 5 year range than in the 10 to 30 year range, right? So yields falling kind of across the board, which is what we saw on Friday for sure. Yields fell. But with yields falling a little bit more in the 2 to 5 year range than in the 10 to 30 year range, reflecting expectations of Fed easing while long end remains sticky. And to that end, I want to just briefly look at what happened to the yield curve in treasuries over the past 3 days. Okay. So this red line here is where things stood before the Jackson Hole talk. The gold line is the day after the Jackson Hole talk by the end of the day. And then the blue line was Monday, kind of pulling back a little bit. So what happened here? We see the red line. We've got this kind of, belly of the curve down here in the 2-year, 3-year, 5-year. And then the red to the gold, right? So all the rates went down by the end of Friday, from Thursday to Friday. The 3-year started out at 3.75 and ended up at 3.64. 2-year went from 3.79 down to 3.68. Those are pretty big moves. But the moves down were greater in the 2-year than out here at the long end of the curve. So we got a bull steepening. Monday, we gave some of that back, and it remains to be seen where we're actually headed longer term. But it's going back to our big picture, and the analysis that we did on Treasury futures last week was a little more suggestive that we could still be in this kind of risk on regime. So even though my cycles are topping in things like the E-mini S&P and Ethereum, the yield curve is not yet giving us a sell signal, right? It's suggesting that if rates are going to come down some more, that we could still see bullish tailwinds in risk on assets like the S&P and Ethereum. I do think we're nearing the end of that, and that we're going to see more of a bear steepening as we progress. And then the later stages of Michael Howell's liquidity cycle will start to unfold after that. I'm still seeing downside risk in gold, although I do think there could be one more burst to the upside before we get that more downside risk. I still see the dollar likely to strengthen, and inflationary pressures and deglobalization supporting commodity and energy prices. We've talked about the bull steepening and the current, short end of the curve. And last week, we also looked at high yield bonds, HYG, technicals even weaker than the S&P 500, right? So oftentimes lead market turns. So that was not encouraging for higher prices. Deglobalization, central long-term drag, right? Raises costs, fragments capital, reduces growth potential. And with key risks, Trump policy shock, potential executive-driven easing could deliver a temporary sugar high into midterms. False dawn, markets could rally in the short term, but late cycle forces remain dominant. So that's still the picture that I'm following overall. I think what we saw on Friday was part surprise of Powell saying possible policy adjustment, together with the market kind of leaning the other way and then getting a huge short-term rally running of the stops on Friday. That remains to be seen whether or not we get follow through or a pullback. So before we get into a few more charts, I just wanted to share a couple of the comments that were left on YouTube. Mitchell Farber, based on the cycle analysis you showed during this presentation, the short-term bond yields are more likely to go down and the longer-term bond yields more likely to go up. And I had some legacy content in my roadmap from the previous week that hadn't been fully updated. So you're right, Mitchell. Thank you for bringing this to my attention. And I did make this adjustment in the overall roadmap. Nicholas, 5-year isn't long-term, but both 5-year and 30-year future cycles are pointing down in this presentation. So rates up, just at a slightly different cycles, right? The yield curve, which you didn't show here, is a different data set and cycle. My cycles on the 30 and 10-year show a bit more steepening into the September-December area than down. So don't disagree there. I don't know why he is even talking about steepening when he didn't even show the yield curve differences. Well, I'm showing the yield curve here. So if you want to talk, if you want to, the differences are between what's the, rate in the 20-year or the 10-year, right, versus what's the rate in the 2-year. So that you can see them visually on this chart. And then lastly, markets seem to, Christopher Capital, markets seem to be pricing in the very best happening. Agreed, very optimistic. And thus far as the PPI read, perhaps the markets are being overly optimistic towards inflation as well, pricing in an expectation that merchants will be eating most of these higher tariff-related costs, not passing them on to the consumer much, and that the tariff-related cost increases will largely be a one-time thing, not a continual rise. That and/or markets are probably pricing in rate cuts ahead, perhaps thinking that the Fed and government are in a corner here, that they have to provide continued fiscal looseness regardless of inflation. The markets may think even if inflation rises, Fed government will let it run hotter than normal. I don't know, all just probabilities I'm gathering from my ear to the street. Totally agree, Christopher. I think a lot of smart people think that what we saw on Friday was a hint that the Fed and Treasury are going to let it run hotter, that we're going to have fiscal and monetary looseness. We're going to see rates cut to go along with the increased fiscal spending and tax cuts, and that the powers that be are going to let the market run hot. I just don't know yet. All right. Let me take a step back for a minute and go back and oops. All right. So just briefly reminding us, right now we're still looking for a correction on equities and risk on assets like Bitcoin, Ethereum into October seasonal lows. But that is in contradiction with the bull steepening of the yield curve, lower short-term rates. And, monetary policy is still in a restrictive range, right? The Fed funds rate at like 4.25 is higher than the 10-year yield at about 3.5. 2-year yield. So there's definitely room for the Fed to ease, and Powell certainly gave us some language that suggested he's more willing to ease than he was, just a few weeks ago. So if that is what we see happen, if we get a 50 basis point rate cut in September, or if some cool inflation but worse unemployment data come out, we could see the markets really rally on the hope of further monetary easing. Of course, that's in contradiction to the longer term cycles that we've been looking at in inflation and in unemployment, which suggests that we should be heading into a stagflationary environment with higher inflation and higher unemployment and lower growth. But there's a lot of levers that the government can pull, both fiscal and monetary policy, to thwart those cycles for a period of time, but not indefinitely. So that's the picture that we continue to track here for our overall macro thesis. All right. Back to some charts. Let me just see here. Anybody's got any burning questions? Good, looks good. All right, so let's continue to nerd out a little bit here. I know I'm not covering a lot of cycles, but this is important stuff. Planning is everything, and we got to understand what happened. So another thing that happened besides Powell's speech, and here's his speech, by the way. Here's the key phrase: nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. That's what sent the markets on a tear. But another thing happened as well, which is this evolution of monetary policy framework. So here is the statement on longer run goals and monetary policy strategy. They put this out once a year. Okay. And actually, I need to go back to the previous year here. This was last year's statement. And in here, they had this statement that says the committee reaffirms its judgment that inflation at the rate of 2%, as measured by the annual change in the price index for PCE, personal consumption expenditures, is most consistent over the long run with the Federal Reserve statutory mandate. The committee judges that longer-term inflation expectations that are well anchored at 2% foster price stability. Let me get down here a little more. In order to achieve longer-term inflation expectations at this level, the committee seeks to achieve inflation that averages 2% and therefore judges that following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. So this was put in like 2020 to say that, man, rates have been really low. Like remember we had zero rates and negative rates in treasuries. And so if they're if they're too low for too long, then it might be okay to let inflation run a little hotter. Okay, above 2%. So that's what it said from 2020 through 2024 for 5 years. And then on Friday, they put out this new statement, okay? And that phrase in there about letting inflation run above 2% is now gone. So the committee reaffirms its judgment that inflation at the rate of 2%, as measured by the annual PCE, is what our goal is. And we judge that inflation expectations are well anchored at 2%, foster price stability and moderate long-term interest rates, and nothing anymore about, letting inflation run above 2%. So again, the markets read this as Powell saying we're going to let inflation run above 2%. I don't get that because that's not what's happening here. We actually removed the statement about letting inflation run hotter above 2%. But a lot of people said, well, it's, they're no longer saying that we're going to target 2%, that we're okay if it's not 2%. I don't get that. That is what was said. I don't think that's what was said. That's also another reason why I'm a little skeptical that Powell gave a green light for running the market hot. I'm just not convinced that that's what we've seen. Okay, so again, take a step back. I know we're getting into the weeds here, covered some pretty esoteric stuff, but this stuff really matters. Plans are worthless. Planning is everything. Our macro thesis is that, if rates don't come down, then this equity market and the risk on, we're closer to the top of that cycle than not, right? And we could see some significant correction sooner rather than later. So far, the market doesn't fully agree with us, right? We saw some bull steepening, all rates coming down, rates on the short end coming down even more than rates on the long end, okay? So that's the steepening and the bull steepening. There's plenty of room for Powell to cut, for the Federal Reserve to cut. There's plenty of pressure, political pressure for that to happen, right? We saw Trump come out and say he was firing the Fed governor whose term runs till 2038, okay? Firing her just 2 years in is a major change to a Fed governor who was, in until 2038. So there's tremendous political pressure for cutting right now. I don't think these cuts are a good idea in the short run. And I think that there's going to be inflation and slower growth in the long run. So the cycles say that's what structurally makes sense to me as well, with deglobalization and tariffs and kind of, more protectionism. So that's kind of where my head's at right now. Nothing's really changed in the cycles outlook from what we did last week. We can drill down and look at some shorter term cycles. We can look at some ideas for individual trades that were presented last week. And let me just see some of the questions here. FSC, love your work. Oh, and Powell didn't, but the risk you did in the market, right? 6400 SPX is make or break right now. I think I could see 6600. I see the market kind of in general pushing past where we all kind of know the support and resistances and then coming back. So wouldn't be surprised to see that. I think a lot of algorithms are running the markets in the shorter term. And so that really can push past those levels that everybody's watching in mass, and try to squeeze a little more flow out of the day-to-day. Being a year ending in 5, wouldn't this be slightly expected? Yes, years ending in 5, according to Edgar Lawrence Smith, are typically bullish. Wasn't the case in 2015, but 2025, I'd say the edge continues to be with the bulls. Absolutely. What do you think for BTC from a cycle perspective? We can look at it for sure. And how many points does the Fed want to lower interest rates? I think they've got enough cover that they could lower by 50 basis points in September. I think that would be a big surprise. But Powell surprised back in 2024 when he lowered by 50 basis points. But 25 is more likely. But I'd say, there's room for 50 to 75 as the yield curve stands right now. In fact, let's look at that just one more time, and then we'll look at some cycles. So this is the yield curve, roughly. Make this a little smaller. Okay. So what is this saying? Right back here in the short term, the Fed rate 4.25, 1 months are 4.5 basically. And then the bottom of the curve here, 2-year to 3-year, is about 3 years, right? So what this is saying overall is that the rates are lowest for around the 3-year, which means that's the belly of the curve. That's the duration that most market participants want to own because they're afraid that over the next 3 years, something bad will happen and that they're going to want to be in bonds for protection, in treasuries within the next 3 years, right? But meanwhile, in the very short term, like 1 month, rates are higher. So we've got an inversion from 1 month to 3 years, quite a bit. The Fed funds is at 4.25. So the Fed could easily lower to, say, the 2-year rate, around 3.75. That would be 50 basis points. But then longer term, investors are saying, I'm nervous about the longer term, so I'm going to ask more insurance for longer term because I think longer term there are bigger risks. So that's kind of the picture from the yield curve. All right. Cycle-wise, we've been tracking the geomagnetic data, and I'm just showing this every week. So far, we have not gotten a turn up in the actual geomagnetic data, even though the cycle turned up a while ago. So we're out of sync here with the geomagnetic data. Geomagnetic storm still very calm. not creating that little psychological dis-ease. Cycle says it should have turned up, but it hasn't. So that also, to me, is part of the complacency of the markets right now. Fear isn't really taking hold. In terms of cycles, so we could look at Bitcoin. And got some pretty strong cycles here, 58 and 217. All of these are above 50% stability. So I absolutely don't like the momentum. I don't like the momentum, negative momentum divergence in Bitcoin, right? We've got the high-end momentum back here in March of 24. New high-end price, not a new high-end momentum, right? New high-end price, not a new high-end momentum, even between these two highs deteriorating. So I think Bitcoin is in a short-term correction at least. We'll see if it's got one more burst to the upside or not. But overall, it looks a lot like equities and Ethereum. So same situation. One idea that popped up on our radar this week. That was showing some interesting cycles. We're going to have a little more data here. So Lynn, I think this is the home builders. Oops. Yeah, Lennar Corporation, the home builders, right? Huge move in momentum. The cycles in the short term look toppy, but looking for a pullback in here, right? From August into September maybe. And on a correction, if it's not too deep, this could be a very interesting buying opportunity. And we could add it to our cycles trades in our collection over here in RiskSmith. Yep. And we'll go back to our cycles trades portfolio. Correlation to the existing portfolio is about 42%. So a little high, but definitely another one that I'm adding to my list of ideas so that, when I see a buying opportunity, which isn't today, that I could add some exposure to the portfolio here with some good uncorrelated trades. And on that note, I just want to briefly share, I know it's very early, but this is the performance of the portfolio that we've been building over the past month, dating back to August 1st when we started doing this. And the black line is the diversified portfolio that we've been building. And look at that, just gorgeous kind of up and to the right without a lot of volatility there. That's excellent performance. The S&P 500 is a little bit above it. The return on the S&P has been 3.34% versus this portfolio just 3.16%. But the lack of volatility here is reflected in the reward to risk relationship. So we're getting reward without a lot of volatility, a lot less volatility. Our volatility is 3.95% versus 10% on the S&P 500. And that's reflected in our very high Sortino, which is a measure of reward earned versus volatility exposed. So really like how this portfolio is performing. And if we look at the individual investments in the portfolio, you can see we have one big winner in Intel. The rest, let's see, what's this? DBA, the agricultural commodity, is up. XBI, the biotech, got a little bit of exposure there to some high beta. What's not working so far is TLT and the dollar. So, but we can see that when you have diversified, uncorrelated assets, you get a smooth ride up and to the right most of the time, without the volatility of those wild moves. Friday, this was Friday, right? If you were or Thursday into Friday in the S&P 500 versus a pretty smooth ride in this portfolio through all that volatility. So that is the beauty of uncorrelated assets. Oops, all right, not using these controls just right yet. All right, so let's see, we've talked about some of these. So I'm not sure what these are. FRFHF. Some asset ideas. I'm collecting ideas. I think next week I'm going to do a bigger show on individual investment ideas. One of the things that's happened in the past couple of weeks is that the whales, the 13F filers, have had to share their quarterly holdings with the SEC. So we know what was the big investors were buying and selling in their portfolios, the Berkshire Hathaways, et cetera. And we can look through those ideas and really next week focus on what are some good ideas from good investors, ideas amongst ourselves that are really showing good trend and good cycle support, and that we might want to consider adding to the portfolio. Let's see let me go back up here. Markets have become irrational. Kicking the can down the road will simply build up pressure that will lead to worse outcomes further down the line, in my opinion. That's exactly my opinion too, right? I mean, there's no way to get around the fact that debt has accumulated. As Dalio has said, we're in the big debt cycle and it can't keep going like it is. Don't think tariffs are going to dig us out of the debt hole. What would have to happen is some massive productivity improvements. A lot of people hanging their hats on, new LLMs leading to massive productivity improvements. I don't believe it. I think there's going to be gains, but I don't think they're going to start doing our work for us. Love the geomagnetic data. Currently inverse. Some of the best trades are when inversions happen and then get back in sync for great setups. Totally agree, Mark. That's where I'm at right now. I've got a macro thesis that says that there's going to be a correction. Probably everything going down, right? Bonds going down, rates going up, equities going down, crypto going down, but we're not there yet, right? We're just not there yet. And the biggest difference about me as an investor today than 10 and 20 years ago is that I'm a lot more patient. I can wait for the things to unfold. I'm not, getting attached to my plans. I do planning, but plans are worthless and planning is everything. Elliott wave analyst calling for the end of the 90-year super cycle, 3-wave up. I'm looking to your longer term cycles for a sell into the 4-wave down. I'm not a Elliott wave expert myself. I do pay attention to some people who do Elliott wave analysis, and it lines up with a lot of what the cycles say too, that we are in for a bigger correction sometime in the next couple of years. Let's see. Nvidia. Thanks for bringing up Nvidia. Hasta la vista, Barbie. We do need to look at that because that is a big event. We got Nvidia coming up. Earnings on Wednesday. That's the big event for the week. So thanks for mentioning it. Absolutely. Sam Altman said last week that AI is in a bubble. Oh, Lord have mercy. Oh, I'm so conflicted because on the one hand, I love these tools. I really do. But the hype claims for them are so absurd, so offensive, so misleading. And to have Sam Altman coming out and going, well, AGI might not be the right term. Maybe we're not going to have super intelligence. Oh, he called it a gentle singularity, right? Not the singularity that supposedly has been right around the corner for 20 years now. No, it's a gentle singularity. We're on the verge of super intelligence, but it's going to take a little longer than we thought. BS. Okay, BS. It's a new search technology that searches through language. That's what it is. It's not super intelligence. And there's going to be a major, major crash in this stuff before all is said and done. I promise you. The rates are lowered. It could cause issues. Those issues would be amplified downwards. Yep. People in debt would feel the pressure. Absolutely. All right. We'll wrap up with a look at the cycles on Nvidia, and then we'll dig more into some individual equity ideas next week. So get me your ideas. Put your comments, especially in the YouTube section, after we're done here today. Let me know what you'd like to look at. We've gathered some from last week. Thank you for posting those. I didn't forget about them. I'm just going to focus more on individual investment ideas next week after we kind of checked in. Do we really have a Powell pivot here or not? And, my working assumption right now is maybe. That may sound like a cop-out, but got to prove it to me. Prove it to me, okay? I'll believe it when I see it. I haven't seen it yet. I think what happened on Friday was mostly algos and short covering. And remains to be seen if it really is a regime change. And we haven't seen it yet. All right. So we'll wrap up. With some Nvidia. We'll start with some weekly data. We'll go to log scale. Oops, not what I meant to do. All right. So weekly data, I mean, boy, the spectrum is kind of a mess. Nothing really to hang our hats on in here. This goes back to, let's use all the data. Maybe the 63 week. But, just looking at the momentum, certainly long-term negative momentum divergence there. So not a lot to be gleaned from the weekly data. So let's look at the daily data. Looks a lot like the NASDAQ and the S&P 500. And even here, you have to practically do log scale because Nvidia's, oh, we'll turn off the log scale actually. So this is 850 bars. We've got some strong cycles, but 291, is that 3 iterations of the cycle? 1, 2, 3 almost. So I probably want a little more data to validate that cycle. Stretched it out a little bit more. We just look at the top 4 cycles here. Very suggestive of some highs being in. So again, I think there's a risk of a rug pull. The rug pull that would be a danger to us, to our analysis, is surprise rate cuts, aggressive rate cuts, Trump winning in his battle with Fed governors, monetary policy loosening dramatically. Not what should happen, but doesn't mean it won't happen. So Nvidia on the whole looks toppy. You know, we've got the same significant negative momentum divergence. This new move up here over the past few days has not turned momentum up significantly after a sell signal. So I look at all this and I'm itching to sell. Keeping tight stops, looking to get into, just to wrap up here. Okay, where am I at? Again, I see charts like Nvidia, the Russell 2000, S&P 500, and I'm itching to short, but liquidity is still flowing. We saw some bull steepening on Friday in the yield curve, suggesting, you know, lower rates in the near term. We'll see. So tight stops on any shorts, small positions, small losses until the dam breaks, and then scale into some larger long-term positions for hopefully some solid gains. That's what I'm looking for. And so thanks again, everybody, for helping me navigate this. Really appreciate the comments, the thoughtful comments on YouTube. Appreciate your ideas. And next week, we'll dig into individual investment ideas and see if we can't find some good additions to our so far so good portfolio. All right. Thanks, everybody. See you next week.